Welcome to Banking Lesson 1. In this video, you're going to learn about the differences between banks and credit unions, as well as why having a bank account is important. Banks and credit unions are both financial institutions which hold on to the money that you deposit into a checking or a savings account. They also provide other types of services such as investments, currency exchange, credit cards, and a variety of loans. Banks are obviously a very important part of the economy because they provide vital services for both consumers and businesses. Your money is safe in a bank or a credit union because they're both insured. Banks have the FDIC, which stands for the Federal Deposit Insurance Corporation, and credit unions are insured by the NCUA, which stands for the National Credit Union Administration. And both are going to cover your accounts for up to $250,000. And it's not like it was after the Great Depression. Back then, if a bank failed, you lost all your money when the bank went under. Now, your money is insured even if the bank goes bankrupt or out of business. Putting your money in a bank is a way safer option than hiding it under your mattress or in a sock drawer. If somebody steals your money, it's gone forever. If somebody robs a bank, your money's insured. It won't even be affected. If you carry cash and you lose it, same thing. It's gone forever. If you have a debit card and you lose it, oh well, you just cancel the old one and order a new one. So, what's the difference between banks and credit unions? Well, a bank offers services to the general public, such as checking accounts, savings accounts, home loans, auto loans, short-term personal loans, credit cards, and investment services. Chase, Wells Fargo, Bank of America, and U.S. Bank are all going to be examples of large retail banks. Banks are for-profit companies, and they make money by charging interest on loans, collecting account fees, and then they reinvest all the money that they make off of you to earn even more profit. Because they're for-profit companies, they're going to pay state and federal taxes, and they're going to be owned by private investors and stockholders. And just like any other business, the goal of a bank is to earn a profit for their owners. Now, on the surface, credit unions are going to look a lot like banks. They both hold deposits, they make loans, they issue checks, ATM cards, debit cards, and investment services. But the real difference between banks and credit unions has less to do with the services that they offer and more with how each institution is run. Members of a credit union typically have a common bond, such as working for the same company or organization, like being a teacher or a firefighter, attending the same college, serving in the military, belonging to the same church, or living in the same community. They're going to have their own private credit unions. But that's not always the case. Some credit unions are open to the general public. Credit unions are not-for-profit banking institutions. Any profit earned by a credit union is invested back into the organization and into the community. Credit unions aren't paying state or federal taxes, and because they're not-for-profit, the profit that they would have earned allows them to offer lower interest rates than banks for most of their financial services, which means that you typically are going to get a lower rate on an auto loan, a home loan, personal loans, if you end up going through a credit union. They also have little to no fees on their checking and savings accounts. You just learned about some of the fundamental differences between banks and credit unions. You'll find a PDF comparison chart of banks versus credit unions in the download section of this lesson. You'll be learning more about banks and credit unions as we move through the next lessons of the module, and in the next video, we're going to go over the different features of checking and savings accounts.